Hey guys, Dave with Moniology on Markets. This is the weekend market review for February 9th and 10th, 2019, where we take a look at various different important sectors in the markets from a weekly perspective to remove some of the short-term noise and give us a better sense of what's actually taking place behind the scenes. Well, we'll start with the 10-year U.S. Treasury, and looking at this one, basically we get a sense that we're in a consolidation phase here. We had multiple highs here, multiple consecutive lows in momentum, and that was a very negative divergence longer term. And so this breakdown was not a surprise. The question was a question of timing. And now the question is, how low do we go? I think ultimately we do break below the 200-week moving average at a 2.5 clip. See what happens there, possibly go as low as 2.1. Possibly if we do get a recession, I'm not one to predict what's going to take place, but possibly this trend line, you just extend this out and we might retest that from the upside around that 1.6 level. But bottom line is Treasuries are not moving higher in the foreseeable future. Looking at gold, gold looks great. I mean, in terms of short term, I think we're going to make a move towards that 1380, 1390 zone. But bottom line is I see a significant positive momentum here. We're at 1331 here at a close, and momentum is higher at this price point than we were at 1369, 1362, and basically where we were at 1377. So whereas previous points, we had consecutive lows in momentum, whereas we had new highs in price. This one is not the same. This one is moving with positive momentum, and the miners are actually following suit and leading the charge, and that's a very positive development. Here we're about to get a 50 over the 200-week moving average cross, which is very positive. So I think my hunch is that we're going to move towards a 1380, 1390 zone here, and then we're going to consolidate for a while, maybe pull back some, but ultimately a break above 1400 is definitely in the cards in 2019. Looking at the high yield junk bond ETF, this one had a nasty sell-off over here, which coincided with basically this price level of RSI. And we found support at the 200-week moving average. We've had a very nice rally, hit new highs in price, but momentum has stalled right at the breakdown point. And so with negative divergence, I think that this is a very significant factor because credit underlies the entire economy. And if credit starts moving lower, then this could be a forecast to what we're going to see in the underlying equity markets. Looking at crude, so crude also is a typically you want to see crude acting very strongly if the economy is moving strong and gaining momentum. And crude broke down over here at this momentum level, and we had a nasty sell-off. But basically, even though this rally was expected from support around this 42 to 45 level, we've got a 50 crossing below the 200. We've got the middle Bollinger Band here moving lower, and I think this price level of 55 to 57 is going to be a top here, and I think we're going to move lower. I don't know how much lower, but certainly I think a retest at that 42 level is definitely in the cards. Nasdaq weekly, Nasdaq had a nice rally here towards that 7400 level where we broke down 74.75. We broke above the 50 RSI, so if it can stay here above the 50 RSI level for a few weeks, above the 50-week moving average for a few weeks, that's a very positive sign. But if we can't continue to build on this momentum, I think the renewed selling pressure, at least for a short while, will take place. Now the Russell has not broken above the 50, and it's going to serve as pretty stiff resistance as it was in previous points here, and we're still below the 50-week moving average. So that's not a good sign. You want to see Russell, you want to see the small caps breaking above Nasdaq and the S&P, and that's not been the case in this particular cycle. Now you're looking at the weekly for the S&P 500. We did break above the 50, similar to Nasdaq. Not shown here, but the advanced decline line is acting very strongly. So, we'll see what happens, but this could be a very constructive head and shoulders if we do move higher. Conversely, this could be right here, this resistance point, and we move lower. And ultimately, I think at some point we're going to at least retest this low here. I think my ultimate level that I see the S&P falling to is this 2100 level. But we'll let price dictate and put my opinion to the side. Now, looking at the U.S. dollar, where we've had a very strong pulse on what's been happening with the U.S. dollar, and although we broke out in April of 18 of this downtrend, we've had this consolidation here, but this consolidation has been on very weak volume, and momentum has not been there. And so what I see as possibly taking place is an inverse head and shoulders pattern here. And so if the dollar does reverse lower, I think we make a test at least 92, consolidate there for a while, and ultimately I could see the U.S. dollar breaking below and testing this downtrend from the upside. So if that's the case, we'll see. But if that happens, then commodities will really take off. Now, looking at the volatility index from a weekly standpoint, I pointed out, by the way, from a daily standpoint, we broke out of its wedge pattern to the upside. I expect this to possibly happen as well from a weekly standpoint. We're finding support on that 200-week moving average, and this is the area where we found support from a momentum standpoint, right around here. So even though this is a very noisy chart, I think that ultimately, if this breaks above that 18 level, I think we'll see a lot of upside in the volatility. And finally, on this chart is the weekly World ex-USA index. And here again, we found resistance at the 50 RSI. No surprise, this is where we had this initial breakdown, and this is where we've had a lot of support and then resistance. So we broke down below the 200-week moving average, and we're still in a downtrend here. And so until this breaks, you don't want to be long from a long-term perspective, this particular sector or index. And I think we're ultimately going to retest this area, but we'll see. I mean, with emerging markets actually performing fairly well with the dollar's weakness and commodities performing strongly, there's a lot of mixed messages that are taking place. So I prefer to be selective in the sectors that I'm looking at right now, such as uranium, such as emerging markets, such as precious metals. You've seen my work there, and we'll make more videos over the next couple of weeks in those sectors. I don't want to be in, at least in equities right now, because there's just so much indecision, and frankly, if you haven't been in them for the last 7 weeks, there's no reason to get in at this point in time, and I would remain very cautious. So that's it for the weekly review, guys. For those of you who haven't seen our new premium service that we're starting to discuss, in July we're going to be launching our premium service where these videos like this, and more specifically with underlying stocks in hot sectors, we're going to be covering them in greater detail, again for education purposes. And if you want to be a part of it, we're opening this up only for 100 spots, and 20 have already reserved. So kudos to the first 20 that have sent me their interest. So if you want to be one of those remaining 80 slots, please send me a note to dave@moniology.com and just let me know. There's no obligation, but we'll hold your spot for you. Thanks again for your support, and follow us on Twitter, StockTwits, and at YouTube @Moniology. Thanks, guys.